to On My Way to Wealth, the podcast where busy Gen Xers can learn financial tips as they navigate life on their way to wealth. And now, please join your host, Luis Rosa.
Welcome, everyone, to another episode of On My Way to Wealth. My name is Luis Rosa, and I'm your host. I want to talk to you about investing today. But before we get started on that, I want to tell you what I feel as a financial planner that you need to know before you even consider investing. The first thing I recommend is having an emergency savings first. Right now, coronavirus has really emphasized how important it is for you to have emergency savings. Now, traditionally, as financial planners, we recommend that you have anywhere between 3 to 6 months worth of expenses saved up. So if your expenses are $3,000 a month, for example, you want to have $9,000 to $18,000, right? 3 to 6 months. Now, I know that's not feasible for a lot of people, but you want to have something as an emergency savings. Right now, 25% of all Americans have 0% saved. Half of all Americans cannot afford a $1,000 emergency. You don't want to be in that boat. A lot of us have been hit with this coronavirus situation in terms of our economy, but it has also presented a lot of opportunities. If you're lucky enough to still have your job and you haven't been going out as much, or maybe you got your student loans deferred or your mortgage deferred, et cetera, you might want to redirect those funds to really, really beef up that emergency savings in case something else like this or something else in the future happens, right? So before you even consider putting your money to invest, make sure you have money set aside for savings that are not tied to any particular investment. They're just in a regular high yield savings account. Forget about interest. This is not the purpose. You want to make sure it's safe and it's liquid. And we're going to talk about liquidity a little later in the episode. So before you start investing, emergency savings. All right. Now, let's move on from there. Second thing I recommend, if you're an employee and you have your emergency savings set or working towards it, and your employer offers a 401k match, meaning that they will contribute on your behalf to your retirement savings plan as a percentage of your base pay based on how much you contribute. So to give you an example, some employers out there might contribute dollar for dollar up to 6% of your base pay. That means that if you contribute 6% of your base pay, they will match you dollar for dollar. Some of them do it as a function, could be 50 cents on the dollar, et cetera. So make sure to read your plan document and find out if your employer offers a match and if they do, what that match is. Because then while you're building your emergency savings, you want to at least take advantage of that employer match, because otherwise you're leaving money on the table, right? So that's the second thing. And then the third thing that I recommend is to get out of debt. Nobody ever got rich paying 24% on a credit card. So when you think about it this way, if you have additional money that you can put away, but you're paying 24% on your credit card, you're probably not going to get 24% return on your investments. So you might want to get rid of those cards first before you start putting money away for it to invest. So short little recap, emergency savings. If you're an employee, and your employer offers a match, make sure you find out what that is. And if you can, contribute to your 401k up to that match so you take advantage of that. Because if you think about it, you're getting 100% return on the amount of money that you're being matched. For example, you're putting in $300 a month. If your employer is putting in $300 a month as well because of the match, you just doubled your money and you're not going to get that anywhere else. And number 3, get out of debt. Now let's move on to investing itself. What is investing? How is it different from savings? Well, investing is when you put either money, time, effort today, and you purchase an asset or an item with the hopes of generating either income or appreciation or both in the future. So in other words, you're giving something up today in the hopes of a greater return, a greater payoff into the future. And that could mean a lot of things, right? Traditionally, people think of investing as stocks, bonds, etc., but it doesn't necessarily mean. I mean, if you go by this definition, it could be a very wide range of things that you're putting your money, time, and effort in the hopes of a greater return. So let's go through some examples. Let's go the traditional route. Right now, people think of stocks, for example. When you buy a stock in a company, let's say you buy an individual share, one share in one company, you now become part owner of that company because you own a percentage. Now, it doesn't mean you can walk into the headquarters and start bossing people around, right? But you get to participate in the profits of that company. You also get to participate in the losses because you're an owner. You have stock ownership. And that could be risky, and that could be a very good payoff either way, right? So if the company goes up, it's doing well. A lot of companies right now during the pandemic are benefiting. So if you buy one of those, the shares have appreciated. So if you bought it at, say, $100 and it went up to 150, you just made $50 on that one share. And the more shares you own, the more money you would have made. And it could go the other way. For example, there are companies right now that are in the travel industry, airlines, et cetera. They have taken a big hit because people aren't flying as much, et cetera. So if you own shares in any airline right now, you're very likely lost some money, right? So that's one type of investment. What if you buy a bond, for example? A bond is different than a stock because a bond is basically an IOU. Let me give you an example. You might be able to you can buy government bonds. You can buy municipal bonds from your local municipality. You can buy corporate bonds. So a corporation basically will give you an IOU and say, look, if you buy this $1,000 bond, I'm going to guarantee you your principal back plus some interest. Now you're taking risk, obviously, if you're doing a corporation because the company could go out of business. Same way in the stock market as well. Companies could go out of business. So there are some risks associated with that, obviously. What are other types of investments? People can buy real estate. That's another popular one. You buy a home today, and it could be for two purposes. You can expect it to appreciate in value in the future. You can also expect it to generate income. So you can buy an investment property and you hope that the value goes up over time, and at the same time put a tenant in there and generate some income. Obviously, you might have a mortgage because very likely you finance that home, but over time you expect the rent to increase and maybe have it paid off in 15, 20, 30 years so that that investment can generate the income of that rent for you to live on later. So that's another very common way to invest. Now, what about things that are so not traditional? Think about investing a little bit more broader than the traditional sense. You can invest in yourself too, right? You're giving up time, effort. So let's say you go back to school or you switch careers or you just invest in a program to educate yourself about a specific topic. You are in fact investing. You're putting your time, your effort now that you're giving up in hopes of a better return later, whether it's a degree or just some knowledge that's specialized that you can then turn around and use in a business. You can invest in yourself in other ways that are non-monetary. You know, what if you join a gym and now you get in a workout program? You're spending time, you're spending effort, you're spending money in that subscription. But what is the return on that investment? Weight loss. It is healthy, right? Same thing, even mental health as well, right? You can do a lot of activities that you're putting money, time, and effort into that ultimately give you a better return on your money because you are generating your self-esteem, your mental health, etc. So think of investing in a much broader way than the traditional sense. And same thing with return on that investment. The return on an investment doesn't always necessarily need to be of a monetary value. Now, how is investing different from saving? Investing is usually for the long term. Saving, you're not expecting a return on your money as much as you would on investing. Obviously, if you have money for like emergency savings, you want to have that in a high yield savings account that's giving you some interest, but the main goal of it is for you to have access to it in case you need it. And that's what's called liquidity. Liquidity is the ability to turn your investment into cash. So when you're considering, for example, going back to real estate, if you buy a house or a building, you want to ask yourself, well, how liquid is this? In essence, how quick can I turn around, sell this, and get my money back out? With real estate, it might not be as easy, depending on how the market is. You have to put it on the market. The property has to be appraised. You have to find a qualified buyer. They have to do a title search in the property, right? It takes a while, as opposed to saving, where you just literally put money in the bank. And if you need it, you could probably just, with a couple of mouse clicks, get that money right back out into another account or walk into a bank and request a withdrawal, right? Very liquid. So that's the difference there. With investing, it's more long term. You're expecting that it'll grow over time, generate income, but you're also taking a risk. So let's talk about some of those risks. Obviously, when you're investing, because you're expecting that it'll grow in the future, there's also the opposite of that, whereas you have to understand that it may not pay off. If you buy a stock, that company can go out of business and you can lose your money. If you purchase a bond, you might not get as much interest as you wanted, or inflation went up much more than you expected, and now the interest you're getting is not as good. What if you put money into a business? Your business can fail. You can open up a restaurant and that can not do as well as you thought. You can invest money in a friend's business, all kinds of things, right? You can buy a piece of art and expect it to go up in value, and maybe it doesn't. Maybe, the piece of art gets damaged or gets stolen, so there's risk in everything, right? And those are the kinds of things that you have to weigh for yourself and figure out whether it's a good investment or not. So understanding risk is the first thing that you want to know going into an investment. How safe or not is this? How likely is it that I might not get any return on my money, or that I might even lose my initial investment? The second thing you want to know is, how liquid is this investment? Can I turn around and get my money right back out? So like with a painting again, can you buy a painting and then just turn around and sell it? Maybe, maybe not. It depends on, the market out there. Do other people have the same type of taste in art that you have, et cetera, right? A stock is pretty liquid. You can typically, if it's publicly traded, you could just turn around and sell it, right? So it's pretty liquid. Think about real estate, like we said before, that's not as liquid. So you want to consider that as well, because if you might need that money in the future, then you want to make sure that the investment is liquid. Now, a liquid investment might not be as lucrative as a non-liquid, and that doesn't always necessarily go hand in hand, but it's something you have to consider depending on how long you need your money back. Number 3, you also want to consider if your investment is diversified. So in the traditional sense, you don't want to have all your eggs in one basket. So when you invest in the stock market, you want to make sure that the monies that you're investing are not concentrated in any given one position, meaning like a specific company. You also want to make sure they're not concentrated in a given industry as well. So even if you have a whole bunch of different companies in the, say, a mutual fund you bought, you don't want to have it all be in the tech industry or all be in the airline industry, right? Because you want to make sure that you don't have all your eggs in one basket to decrease the likelihood that you lose all your money in one shot. Now, this is where hiring a financial planner makes a lot of sense for a couple of reasons. One is, financial planner can help you determine your risk tolerance. Understand how risky is this investment for you. Understanding the risk is going to be a huge part of the investment, because you want to know how likely is it that you are in fact going to get a return on investment. It's an educated decision. That's one of the things a financial planner can point out for you. Number 2, figure out your own risk tolerance. Help you determine via a series of questions, is this an investment that makes sense for you based on your time horizon and how well you sleep at night, frankly, They'll ask you questions like, well, if you lost X percentage, how would you feel? Is this something you can tolerate? And also, can you afford it, right? Can you afford to lose money in this? Because if you can, then maybe that's not the right investment for you. Also, financial planner can help you not make emotional decisions. It'll be a third party that does not have the same emotion that you might have towards a specific investment. So, to give you an example, a lot of you out there that work for companies that offer you company stock, if they're publicly traded, a lot of you have a very high concentration. I've seen that a lot with clients where they have a very high concentration in an employer stock. And overall, they might feel like they're conservative, but then the 401k shows a different story. And that can pay off, right? I've heard of a lot of stories where people had company stock in their 401ks and it paid off greatly. But the opposite is also true. And there are examples of both. The company might not do as well as you thought. So you don't want to have a high concentration. You want to make sure you sit down with a planner and you come up with a plan to diversify your portfolio if you, in fact, do have a high concentration of your employer stock. And the other thing that a financial planner can help you with overall is manage that investment, help you understand what it is that you're investing in, periodically have reviews and see if the investment still makes sense for you and adjust accordingly. Not all financial planners are made equal. So make sure that you understand too how the financial planner gets compensated. So that's one question you want to have. Make sure that your financial planner is a fiduciary. A fiduciary has to have your best interest at heart. And I know that kind of makes sense, right? You're like, well, yeah, if I'm investing money with somebody, they should have my best interest at heart. But that's not necessarily the case. A lot of financial planners or investment advisors, whatever they call themselves, are not fiduciaries. They just have to sell you something that is suitable. But something that is suitable for you does not necessarily mean that it's the best thing for you, right? So that's a key distinction there. So you want to make sure you understand how your financial planner gets compensated and also ask them if they're a fiduciary and find out what kind of credentials they have. Because a lot of the times there's a lot of terms out there that are just simply made up, like you have investment consultants, wealth managers, that say like you don't go to wealth management school. So there are certifications like certified financial planner, chartered financial consultant, things of that sort that you want to ask your financial advisor if they have those certifications. And before we wrap up, I want to tell you about this investment. I want you to think about it in terms of investment. Picture yourself right now inside a investment advisor's office, and they tell you, hey, I have this great investment for you. What do you think of this? Number one, your initial investment will lose value immediately as soon as you purchase it. So you're going to give a lump sum, and that is going to immediately lose value. Sounds good so far? You have to contribute to it every single month. So you're going to continue to add to it, and your investment will continue to lose value. Number three, on top of that, you're going to have some non-tax deductible expenses during the life of this investment, in addition to your monthly contributions. And then finally, when you sell it, this investment is going to be worth less than the initial amount you invested in, the monthly contributions, the non-deductible expenses. Who's signing up for this? I'm sure by now a lot of you guessed what this is because a lot of us already have this investment. It's a brand new car. When you buy a brand new car, immediately it loses value. If you say you walk into a dealership today, you bought a car for $40,000, and the next day you decide, you know what, I made a mistake. I want to get this back. And you go back to the dealer and they say let's say that they're able to accept it back and say, yeah, no problem. We'll take the car back, undo the deal. Do you think you're going to get $40,000 back for that car? Absolutely not. Even if you didn't drive it. The reason is because as a new buyer, if I walk in there and I say, hey, I want to buy this new car, and they say, oh yeah, we just have, we have this one here that's brand new for 40 grand, and we just have another one that was just returned yesterday. It only had one owner. They only owned it for a day. Well, what do you think? that me as a new buyer, I'm not going to want to pay full price for that, right? It's also supply and demand, because why would I want to do that when there's a brand new one on the lot? So immediately loses value. You're going to have a car payment, right? Most of us don't buy cars brand new cash. So in addition to your initial deposit, you're going to have a monthly car payment. Then you're going to have expenses, right? There's going to be oil changes, maintenance, tires, etc. during the life of the investment. And then at the very end, when you sell it, the car's still worth less than all the money you put down, all the money you paid to the loan, all the money you had in expenses. It's still going to be worth less. So the reason I bring that up is because don't think of a car as an investment. If you need a car to get to and from work, school, etc., you need one. Not saying that you should never treat yourself to a brand new car either, but I want you to think of it in terms of investment. A car is not a good investment unless you're buying one of those like classics, right? That have a very unique value and unique market to them. But a regular good old car that you buy out there is not an investment. So think about the fact that when you're investing, you're contributing not just money, but it could also be time and effort. So I want to close with just saying, invest in yourself, invest in your health. You're not stuck with the decisions of the past. So you can always change course if you're unhappy with your career, your job, etc. Start thinking of ways that you could start investing in yourself. And that could be an online course, that could be meditating, that could be gym, reading a book, whatever it is. Make sure that you put time and effort into yourself because you're worth it. And the return on investment is going to be greater than any monetary investment that you could ever get. Thank you all for listening. I hope to see you in the next episode. If you have any questions, send me an email at luis@onmywaytowealth.com. Stay well. Thank you for listening to On My Way to Wealth. If you have any questions, please send me an email at luis@onmywaytowealth.com. The information provided here is for information and education purposes only. The opinions expressed herein are solely those of myself, unless otherwise specifically cited. Material presented is believed to be from reliable sources, and no representations are made by my firm or myself about other parties' information or accuracy or completeness. All information or ideas provided should be discussed in detail with a financial advisor, accountant, or legal counsel prior to implementation.